Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive. Imagine farming, but totally transformed. Crops stacked high in shiny buildings, maybe right downtown, no soil needed, perfect climate, feeding the world sustainably. That's the big promise of agritech, especially vertical farming. It sounds amazing.
It really does. And the sources we've looked at, well, they definitely capture that optimism. There's a strong belief in the potential here, how agritech could boost productivity and meet some really critical sustainability goals for farming's future.
Sounds like the dream, right? But this deep dive, it's about more than just the shiny vision. We're pulling back the curtain, using insights from, financial reports, research papers, industry chats, trying to get a handle on the real economics and the, frankly, significant challenges hiding beneath the surface, particularly for vertical farms.
Exactly. Our goal here is to boil down what really matters for you. Maybe if you're new to farming altogether, or you're thinking about stepping into this high-tech space, or maybe you're just curious. We want to get to the actual costs, the risks you can't ignore, and what the data really tells us, beyond the hype.
Okay, let's get into it then. The first big thing that jumps out, despite all that positive buzz, is, well, a pretty stark reality check financially for a lot of these ventures.
That's right. You'd think the market drivers are all pointing the right way. Population growth, climate change hitting traditional farms, people wanting local food. But the sources show a tough decade. Lots of vertical farming startups just haven't made it. It's clear a cool idea isn't enough.
And you see that reflected in the investment numbers, don't you? Global investment in agritech startups took a massive hit. Dropped from, $30.5 billion in 2022 down to $15.6 billion in 2023. That's not just a small dip.
No, it really isn't. It suggests investors are cooling off, maybe realizing some ventures were perhaps a bit overvalued.
It feels like people still believe in the tech's potential, but actually making it a consistently profitable business. That's turned out to be way harder than many thought.
Precisely. The path to viability is proving tricky.
So if you're actually thinking about starting one of these farms, what are the basic economics you absolutely need to get your head around? Let's do a quick Farm Economics 101, but specifically for this kind of setup.
Okay, first hurdle, startup costs. The sources are unanimous. You need serious capital up front. We're not just talking about buying some land. It's finding and paying for premises, often in expensive urban areas, and then installing these really complex grow systems.
Right. You mean specialized irrigation, the fancy LED lighting, ventilation, all the computer controls, plus the basic stuff like seeds, nutrients, water to start with. It adds up fast.
And it doesn't stop once you're built. The operational costs are ongoing, and relentless is probably the right word. Especially energy, running those lights, keeping the climate perfect 24/7. That means huge electricity bills month after month.
Which seems to lead straight into one of the biggest roadblocks mentioned everywhere. Return on investment, ROI. It sounds like it's incredibly hard to actually model or predict accurately.
It is, and that uncertainty is a major barrier. If you can't clearly see when or even if you'll make your money back on that massive initial investment, it makes farmers and investors very hesitant.
Plus, there's a fundamental mismatch, isn't there, between investor expectations and how farming actually works.
Yeah, a big one. Investors often want to see returns pretty quickly, maybe in a 3 to 5 year time frame. But agriculture, especially setting up something new like this, just takes longer. You need time to implement the tech, optimize how you grow things, build your market.
And the sources point out traditional farming often works on much slimmer margins anyway, maybe like 1–2% return on capital. That's totally different from what tech investors are often chasing.
Absolutely. And even in a controlled environment, you're not immune to outside shocks. Market prices for other produce can shift, energy prices can spike. Things you can't control inside the building still affect the economics outside.
Right. Controlling the internal climate doesn't mean you control the external market climate. Makes sense. Okay, so beyond the obvious costs and the tricky ROI, the sources also mention some risky assumptions that people tend to make when looking at these ventures. What are those?
Well, a really basic problem is the lack of solid data. There just isn't much independent, peer-reviewed research out there detailing the actual economics, construction costs, operating costs, real-world yields over time. That kind of reliable data is surprisingly scarce in the literature.
And that's made worse by a lack of standardization, right? Every farm seems to be using slightly different tech, different setups, measuring things differently.
Exactly. Without common benchmarks or a standard way to collect and report data, it's almost impossible to compare performance reliably. Are you comparing apples to apples or, apples grown under totally different lights and different systems? It's hard to tell.
So this data gap messes up the financial models people use.
It really does. Most analyses tend to use what are called deterministic models. Basically, you plug in one fixed number for yield, one for cost, one for price, and it spits out a single prediction. But reality isn't like that. It's full of uncertainty. Equipment breaks, energy prices fluctuate, pests might get in.
So you need models that can actually handle that randomness.
Yeah.
The sources mention things like P-boxes, imprecise probability.
Right. Those are more advanced techniques. They let you work with ranges and possibilities instead of just single best guesses. They're useful when your data is limited or messy, and you need to understand the range of potential outcomes, the potential upsides and downsides, not just one specific forecast.
Okay. And are there other assumptions people miss?
Yeah, another one is overlooking things like the learning curve. As the farm team gets more experience, they usually get better. Yields might go up, they find efficiencies, maybe costs edge down slightly, but a lot of initial plans don't really factor in that improvement over time.
And what about basic business economics? Things like economies of scale.
That's another surprising gap mentioned. There's a lack of studies looking at fundamental microeconomics, like figuring out the optimal size for a facility to minimize average costs or how to maximize profit given the constraints. That kind of analysis is crucial if you want to scale up profitably, but it often seems to be missing.
It feels like the tech excitement maybe got ahead of the boring but necessary business analysis sometimes.
That's a fair assessment based on what we're seeing in the sources.
Okay, to make this more concrete, let's look at those case studies.
Yeah.
First up, that real-world vertical farm in the UK. What was the story there?
Right. This one was interesting. It was retrofitted into a rented basement, and crucially, it got help with subsidized rent, electricity, and water. So it had a bit of a cost advantage starting out. But even then, looking ahead 15 years, the predictions were all over the place.
How wide was the range?
Massive. Cumulative net profit could be anything from a 1.5 million ton loss to just over a 1 million ton profit. And the final ROI was similarly spread from minus 42% to plus 61%.
Wow, that huge range really screams uncertainty, even with subsidies.
It does. And the key finding was that even if they managed to scale up production and upgrade tech as planned, about half the possible scenarios still ended up below what you'd normally consider an acceptable return on investment.
And what about the risk level?
The analysis put it starting in the critical risk zone, that's the highest level. Over time, it could move towards substantial risk, but that depended on managing a whole host of operational risks effectively. The suggestions for that farm were extensive. More capital, way better data collection, strict cleaning, efficient distribution, cheaper packaging, fine-tuning nutrients, adding CO2, better climate control, smart energy buying. Basically, a lot needed to go right.
So even with a leg up, it was far from a sure thing. Now, how did that compare to the hypothetical Japanese case study?
That one modeled a farm built from scratch in a purpose-built leased facility. Because they assumed more precise data going in, the financial projections had a narrower range. The 15-year cumulative net profit was predicted between a 2.6 million loss and a 4.6 million profit, with ROI between 0% and 23%. So in most scenarios, it was profitable and had a positive ROI.
Okay, that sounds significantly better on the surface.
It does initially, and the risk assessment started in the safe zone. And this is a big, but if significant operational risks hit, things like power outages, major equipment failures, or a serious crop failure, the model showed the probability of insolvency hitting 75% within about 5 years by 2029.
75%? That's incredibly high.
It is. It means that while the base case looked okay, the operation was extremely vulnerable to disruptions. It pushed the future risk profile down towards that substantial category, even if it started safe.
So what was the key recommendation there to manage that risk?
Diversification, specifically diversifying revenue streams, maybe offering things like farm tours or educational programs, so the entire business wasn't solely dependent on selling crops. If you had a crop failure, you'd still have some income, buffering the blow.
That makes a lot of sense. Don't put all your eggs or lettuce in one basket.
Exactly. It builds resilience.
And finally, there was that feasibility study in Cameroon. What did that tell us about applying this tech in a developing country context?
That study really highlighted a different set of challenges on top of the usual ones. Extremely high initial costs for infrastructure and reliable energy were huge barriers. Plus, general technological and infrastructural deficits like an unreliable power grid or just not having local technicians who can fix the advanced equipment.
And policy issues, too.
Big time. The study stressed the need for supportive government policies, but often found the opposite. Maybe unfavorable taxes, a lack of incentives for this kind of farming, unclear regulations. Add to that potential political instability, existing problems like urban pollution, and even possible resistance from traditional farmers, and you have a very complex picture.
So it's not just about dropping the tech in. The whole ecosystem needs to be ready.
Precisely. But the study wasn't all negative. It did identify potential. For instance, aquaponics combining fish farming with hydroponics looked like a good fit for local conditions in Cameroon, potentially more cost-effective and sustainable using resources efficiently.
And the big takeaways seem to be adaptation.
Absolutely. You can't just take a model that works, say, in Europe or Japan and expect it to work perfectly in Cameroon. Success hinges on creating a customized business plan, one that's tailored to local resources, the specific climate, what crops people actually eat there, how the local market works, and importantly, how it fits into the existing culture.
That need for local tuning seems to be a recurring theme.
It really is. Generic solutions often fall short.
Okay, so let's try and pull all these threads together. We've talked about the investment cool down, the tough economics, the data problems, the case studies. What are the essential lessons here? If you're listening and thinking about getting into this maybe as a farmer, what do you need to take away?
For you as a potential farmer, the sources really hammer home. Be realistic about the huge upfront costs and those significant ongoing operating expenses, especially energy. Really understand that the return on investment is genuinely uncertain. You need a super robust business plan, maybe using some of those tools we mentioned that can handle uncertainty, because simple forecasts might be misleading.
And it's not just about the money, right? Skills are an issue, too.
Definitely. Finding people with the right skills to run and maintain these complex systems is a challenge. And there's sometimes a disconnect. The tech isn't always designed with the farmer's day-to-day reality fully in mind. Adoption requires training and support.
What about selling the produce?
Market access can be tough. Getting reliable deals with supermarkets or restaurants isn't guaranteed. And currently, there often aren't strong incentives for buyers to pay a premium just because it was grown indoors sustainably. Also, remember that Japanese case study, think about diversifying your income streams early on. Maybe tours, maybe consulting, something beyond just crop sales to cushion against risks.
And learning from others seems key.
Yeah, success stories help, but the sources suggest more peer-to-peer learning and practical pilot farms are really needed so people can see what works, share tips, and build confidence.
Okay, now flipping the coin. What about for you as a potential investor looking at this space? What are the critical lessons from these sources?
For investors, the big message is understand the agricultural context. This sector has long lead times for returns and typically operates on much lower margins. That 1-2% return on capital we mentioned is very different from many other tech sectors.
And be very clear-eyed about the risks.
Absolutely. Even with controlled environments, things go wrong. Equipment fails, pests can still be an issue, energy prices are volatile, competition is real. These aren't just minor hiccups. They can seriously impact viability.
And that data problem we discussed is crucial for investors too, right?
Hugely. Data is often scarce and not standardized. That makes doing your due diligence with traditional financial models very difficult. You might need to be comfortable with or even seek out analyses that use those more sophisticated methods for handling limited data and uncertainty.
There's also that mismatch in expectations you mentioned earlier.
Right. Investors might push for quick commercial results, but the agri-tech companies themselves might need more time for R&D, for scaling, for finding their market fit. Managing that timeline difference is key.
And finally, the regulatory environment adds another layer of risk.
Yes. The sources indicate a general lack of confidence in government strategies and support frameworks, both from farmers and developers. That uncertainty around regulations, incentives, or even stability in some regions is a significant factor for investors to weigh.
It really is a complex landscape. You have this huge promise for food security, for sustainability, especially in challenging environments, but then you have these massive economic, technical, and market hurdles standing in the way.
Exactly. The high costs, the deep uncertainty around ROI, the lack of good data, the specific operational risks like power failures, and just a general disconnect between farmers, tech providers, and investors. These are fundamental challenges, not easily solved.
And as we saw clearly, one-size-fits-all solutions just don't work. Success really demands tailoring the approach to the specific local context, the specific needs.
And thinking about why the sector feels a bit fragile right now, why there's talk of a potential bursting effect, the sources suggest it's how these challenges all pile up on each other. You have regulatory hurdles, unclear policies, maybe bad tax structures mixing with infrastructure problems, especially in developing regions. That creates a baseline of uncertainty.
Then you add the supply chain difficulties, like getting products to market efficiently or convincing buyers to pay more.
Right. And on top of that, you have the purely financial and market risks, volatile costs like energy, strong competition, and crucially, that big drop in investment we saw combined with the history of high failure rates for startups.
So it's not just one thing, it's the combination.
Precisely. These factors interact and amplify each other. They create a kind of systemic financial instability that makes many ventures very vulnerable. When the flow of investment slows down, like it has recently, the operations that haven't realistically tackled these combined challenges are the ones most likely to fail. It's this compounding effect that could really shake the sector.
That really highlights how interconnected everything is. So considering the huge amount of capital needed, the very real risks we've laid out, and this often unclear path to actually making a profit that the sources detail. Here's a final thought for you, a listener, to chew on. If you're interested in this space, how can you genuinely tell the difference between a venture that's built on true, solid innovation with a realistic business plan that tackles these complexities head-on, versus one that's maybe running more on hype and is ultimately vulnerable to these harsh economic realities we've uncovered today?
We hope this exploration has been valuable. Thanks for joining us on the Deep Dive.
Hitting that like button and smash that subscribe.